when one person's everybody's biggest customer and they go under, you have this domino effect. And FTX should have happened in June, but they papered over the cracks by essentially cheating and borrowing customer money to fund their own trading operation. But two things: I think it's a good thing because the space needs to grow up. We need quality regulation, and we need better accountability within the industry. So I think the space grows up, much like the hedge fund industry after Bernie Madoff. Hedge funds didn't die. In fact, the opposite happened. They accelerated because hedge funds became more investable because people knew what the risks were and what they were looking for, that kind of thing. I also note that very interesting is Ethereum, which is the second largest token, has nowhere near made new lows. It's still 30% or 20% up from the lows. And that's kind of interesting to me, that we've just had this gigantic blow up and the market can't sell off significantly. So it kind of tells me that this is probably the end of the move and not the beginning. And I know everybody's terrified of knock-on effects. It's like we had an earthquake here 2 years ago, and for the next week you're always worried about, okay, is that another earthquake coming? That's what I think people are doing. They've got kind of post-traumatic stress disorder. And I actually think that we're near the end of that. But you've got to understand what this space is. This is the largest ever VC experiment in real time that the world has ever seen. Normally, average investors would never get the chance to invest in early stage startups. And if you look at a VC portfolio, a lot of those go bust. Some of them succeed and some of them kind of go nowhere. That's what VC investing is. The crypto space is that. It's VC investing in Web3. So things are going to go bust and things are going to be shockingly amazing in their performance. Now, the way to deal with that is to have either broad exposure to the space, so therefore you can afford if some things go wrong, or you just buy the highest quality. But you should expect things to go wrong. So the best thing to do is avoid anywhere where there's leverage. Keep your tokens in your cold storage wallet and just avoid leverage at all cost. It's leverage that blows things up. It's not generally failure of markets themselves. It's that issue. Terra Luna was a badly constructed stable coin, but there was leverage involved. With FTX, it's all about leverage. 3 Arrows Capital, all about leverage. Celsius, leverage. Voyager, leverage, they're all the same. They're giving you rates of interest when there's no central bank. So if they're giving you rates of interest, it's becoming manufactured from something. And it's actually getting manufactured from people borrowing cryptocurrencies, and they will pay an interest to borrow it. So what's happening is market makers are essentially laying off the risks on the public by saying, hey, we can give you 8% on your Bitcoin. Bitcoin doesn't have a yield. Now, there's things like Ethereum staking, and they're not leverage based. They're actually built into a smart contract, and that's a different thing altogether. So I think this was the final stage, the big puke of everything else that's fragile in the system. Sure, there'll be some other tremors that come after this, after the big earthquake, but those tremors will be increasingly small because there's pretty much nobody left in the space that uses leverage. The big exchanges went under, the big trading firms went under, the lenders went under. Who's left? I just don't know. I don't see many anymore. Is there some risks in some of the US banks like Silvergate? Potentially, but we don't have much exposure to them. The public doesn't have much exposure. So I don't really see massive risk left in the system. People like myself, I self-custody. That's what I love about crypto. I can own my assets. I can make them safe and nobody can touch them. The world can burn and I still own my crypto assets. It's like keeping, gold in a vault, but this is a digital asset I can move around. So I think the world splits between institutions who probably want to use the bigger institutions that feel safer and more regulated, and others who want to store their own assets so 2008 can't happen again and the banks go bust, because banks have a habit of doing that too. So the value of crypto is, if we live in an increasingly digital age, and that trend is igniting, we need the ability to transfer and store value in that digital age. So if you think about it, one way is the more digital the world gets, the faster computing power gets, the more, the cheaper everything gets. Everything that's based around computer in value. But what cryptocurrency does, and NFTs and things like that, is they actually create digital scarcity. So now you've got an asset that's in a virtual world that we can send instantaneously, that has this blockchain where we can store things. So we have a system of money that moves around, a system of value, the storage of assets. And so what we've created is a brand new financial system. So why cryptocurrencies are so volatile is because they're basically a call option on that future use of the system. And that's volatile as the market tries to reassess the probabilities of certain things working and not working. So, we're not in the finalized state. We're at the beginning. We're somewhere like the internet in 1998. So I know many in the space are kind of libertarian and biased and we don't want regulation, but some levels of regulation will stop or produce less outcomes like FTX. We know that regulation still has that because 2008 happened. But I think regulation generally is the green light that all the institutions are looking for. And I speak to a lot of them. They just need more regulatory clarity. NFTs are a breakthrough technology. They're basically every single thing that we do as humans is basically a contract, whether it's a social contract or a written contract. Me appearing on your show is a contract. You sent me an email, I agreed, we booked a time. Every contract can now be recorded on a blockchain. And that's what smart contracts do. That's what NFTs are. So NFTs can be used for everything from tickets to musical IP to artwork to so many use cases. Even the insurance industry, the securities industry, every single derivative is essentially a contract. All of that can go on NFT. So NFTs are an enormous breakthrough. So if you think of the blockchain as the underlying technology, the NFT is that contract of which the world works. And the digital contract world is where the future of everything is, because it destroys middlemen, destroys costs, and makes things hyper efficient. My crypto position, it started off with Bitcoin when I took a very big bet in 2020 and said, I'm putting 100% of my liquid net worth in this bet, and this is a 10-year time horizon opportunity. I still have 100% of liquid net worth in the bet, and I still add to it. So when I get new cash flows, I add to that position. And, I'm not fazed by the ups and downs. I've been in this space since 2013, and you've got to expect 75% pullbacks. But really, it's within an exponential uptrend over time. So the space is actually growing at about 135% a year. So you're going to get pullbacks, but over time, you make significant rewards. And, I first bought Bitcoin in the space at $200, and I thought it was expensive then. Then it hit $68,000. Then it came back down to where we are today, about $20,000. It's all part of the ride. But overall, the trend keeps going, and I'm going to remain irresponsibly long. Now, when I say irresponsible, it's a really important thing for people to understand. I don't use leverage. I don't need the cash for anything else. It's a long-term bet. I put it away and forget about it. So I'm not putting more money than I can afford to into it, and nobody can take it away from me because I'm not using leverage. Those are really important points of this, and I have cash flow. So firstly, the timing for investment in the space is very good. Monetary cycle has pushed the price of cryptocurrencies very low, and it's now onto that long-term uptrend, the bottom of the long-term uptrend. So it's a very interesting juncture when monetary policy is about to change. The best way is to think about dollar cost averaging in. Don't just try and pick a price and say I found the low, but just buy it over time and then put some of your income into it or some of your savings in. Now, it depends what your risk appetite is and how old you are and whether you need the capital. If you don't need the capital, knock your socks off. Do as much as you want. Now, for most people, that might mean 10%. So if that's 10% of your liquid net worth, then it could fall 50%, and you're losing 5%. It's not the end of the world. And if you're in your 30s or whatever, you're fine. If you're younger, take more risk. If you're older, take less risk. And it all depends on what your disposable income is like and if your income is secure. If you've got secure income, this is one of the greatest wealth accumulation opportunities. It's the best performing asset in all recorded history in the shortest period of time. We've never seen anything like it. So you should get involved, but it's all about your risk tolerance. If you are worried, if you're checking your P&L every day, you've got too big a position. The idea is you shouldn't really care. And then you look back and go, oh my God, it's gone up a lot, or, oh, it's down, I need to buy some more. That's how you need to think about it. So it varies for different people. As I said, I'm comfortable with 100% of my liquid net worth because I don't need the capital because I've got income and I've got assets. But I think most people really something like 10% is not a bad idea. You know, I'm pretty confident, obviously, in Bitcoin, very confident in Ethereum. And then after that, it becomes more speculative. Now, I quite like Solana. Now, Solana's caught up in this FTX thing, so prices are distressed. But cryptos can't go bust because they don't have leverage against them. They just exist. So is that going to perform or not? I think it possibly does because there's big adoption. I also think looking at the DeFi space is interesting because these centralized exchanges keep blowing up. So things like Uniswap and Aave, they're decentralized and they've been much safer. So I like looking at those too. So I would take a broad bet covering different sectors and balance your risk accordingly.